Hello, my name is Matthew Bell. I am licensed in health and life insurance products, and today I wanted to talk a little bit about the various approaches that are used to calculate an insurance need. In general, insurance needs are going to be relative to a lot of different things, and some of them are going to be objective, some of them are going to be subjective. Some things that are going to be objective that are going to relate to a person's insurance needs are going to be things like the actual dollar amounts that they would need to replace in the event that they died in terms of income lost to their family. Some will be their health. Some might be what they would expect to pay in that area for funeral costs and things like this. Their relationship statuses, how many people are depending on their income and that kind of thing. Things that are more subjective that are going to relate to their insurance needs are going to be things like what purpose do they want these policies to serve? What are their values? Do they value, let's say, legacy planning? Do they want to leave money to their kids or grandkids or charities? Or do they want, as some people put it, their last check to bounce? As we proceed further on, some of these differences in terms of purpose and things like this should become a little bit more apparent as we kind of work our way through these various different scenarios. But I'm going to give 5 different approaches or 5 different things that are relevant in terms of calculating the insurance need. And each of these things is going to have slightly different recommendation, and each of these is going to have its own proponents and its own opponents. And I'm just going to leave it to viewers to kind of listen to these, and then in conjunction, hopefully, with a person who is a competent advisor in your area, somebody that you can actually talk through these different perspectives with, and then come to some agreement about how to calculate your own insurance need. The way I'm going to frame this discussion is I'm going to start by unpacking a few approaches that paint with a broader brush and speak in more general terms, and then I'm going to segue into approaches that paint with a narrower brush, or if you want to say it, are more detail oriented. So the first approach out of the 5 that I'll go into is just going to be debt coverage. We could call it debt coverage. And the idea of this approach is that you would simply just tally up your debt, and in order to not saddle your survivors with this debt, the idea would be you would try to match your insurance benefit to the amount of debt that you have. So for example, some common areas where a person might be indebted would be in a mortgage. Let's say you have a $200,000 mortgage. Let's say you have student loans, $25,000. Let's say credit card debt of $10,000. Let's say a vehicle loan of about $25,000. So the mortgage is $200,000 plus the $25,000 vehicle loan plus the $25,000 student loan plus the $10,000 credit card debt, and you have $260,000 of debt. One strategy then would be to take out a $260,000 policy that is designed to cover that debt in the event of your death. So in the event of your death, your husband, your wife, your kids, whoever, are not going to have to pay those expenses. And then sometimes you might tack on a little bit extra for, let's say, final expense planning. Now, the debt strategy is going to have some complications, and I'll get into some more of these further down the line. But one complication with debt is the fact that debt tends to go up or down. If you are making payments on the debt, then the debt will decrease over time. If you are racking up additional debt, then the debt might increase, and for many people, it's kind of a combination. So making a determination of what your debt is on some day and time, that is going to then help you to get a fix on what your general debt situation is, but tailoring a policy to your debt today may not be a good fit for your debt 5 years from now or 10 years from now, so you want to bear that in mind. Now another approach, so number 2, would be a multiple of your income. So there are some people who speak, for example, I ran across some summaries of what Dave Ramsey and some of his teachings, and what Dave Ramsey suggests is, at least from what I saw, that you carry insurance of 10 to 12 times your income. So let's suppose a person is making $100,000 a year, well then 10 times their income would be $1 million, 12 times their income would be $1.2 million. So whereas the first strategy was geared toward debt, this strategy is geared toward making your insurance payout a function of your income. One question that pertains to income replacement in insurance would be, do you want that death proceed to be kept as principal somewhere and just live off the interest, or do you want to live off of the death proceed itself? I'll get into more detail on that in a little bit. Now, another approach is going to be called human life value. Now, human life value calculations are used not only in life insurance but also in the court systems. So sometimes for wrongful death or other types of tort cases and things like this, there may be a calculation if a person is killed during his or her working years. Sometimes the courts will try to make a determination of that person's life value, and that is then where some of the judgments in terms of monetary judgments proceed from, or at least they're tethered to this life value. There's a similar calculation that's done in life insurance. It may not be exactly the same as the way that they calculate it in a court situation, but here's kind of the general idea. So let's say, again, you've got a person making $100,000 a year, and let's say that person is 30 years old, and that person anticipates retiring sometime between, let's say, age 60 and age 70. It's quite a range there, but sometime in that decade they intend to retire. So at the age of 30, their human life value is going to be calculated standardly. It's going to be a function of how many years they have to work until retirement, which in this case would be 30 or 40, and how much they make in a year, which in this example is $100,000. So in this case, the human life value calculation, the initial calculation would be 30 or 40 times 100,000. Which means you would have a result of $3 to $4 million of human life value. Now, we take that figure and it's generally going to be offset or reduced by some factor, and 70% is a common factor, and the reasoning here is that if you're trying to match income, then really what you're trying to match is going to be the income after tax. So whereas you can apply the formula to before tax dollars, we're thinking, well, we're trying to replace income. If a person's actually making $100,000, they're going to be taxed on that. So the amount they're bringing into their household, the spendable amount, is less. In addition to that, when a person dies, then obviously certain expenses go away. So there are no, if a breadwinner dies, then that breadwinner is no longer having to spend, or the family is no longer having to spend money on that breadwinner's clothing and food and medical care and the like of these. So because of this tax situation and because of the fact that certain expenses are going to go away, we usually take that initial calculated number for the life value and then bring it down a little bit. So the initial number we got, remember, was $3 or $4 million, right? Depending on whether or not that person's going to actually retire at 60 or retire at 70. And so the thing to do next would be to multiply it by 70%. So when we do that, you can either multiply 3 million by 70% and 4 million by 70% to get your range. It'd be 2.1 to 2.8 million. Or you could multiply the 100,000 by 70% and then multiply that out by 30 or 40 years. So 100,000 times 70% is 70,000, times 30 is 2.1 million. 100,000 times 70,000 times 4 years is 2.8 million. So you get it the same number either way. But in that case, the human life value is a little bit different than the multiples approaches, the multiples approach that we surveyed earlier, but it's also focused on income replacement. And the question with the human life value approach is going to be, how long of a calculation do you want to make? So it's not uncommon, in fact it's very common, to calculate human life value from whatever today's date is until the projected retirement date. But this assumes that there is an adequate retirement plan in place, for one, and it assumes that the funding is available for the insurance. So if the calculated need is 2.1 and 2.8 million, and that amount exceeds the person's ability, let's say, to pay based on income and expenses, then we would look at income and expenses and see if there are things that we could do to sort of reallocate some of the money there. However, the other perspective would be we could reduce it. And one way of reducing the human life value further would be to say, well, let's think about something like, if you have two, let's say you have a couple of kids, and one kid is 6 and the other child is for? Well, one perspective would be take the number of years until that younger child is going to be emancipated. So you might think until age 18, or maybe they're going to be around through college and you intend to support them there. So if the 4-year-old is going to be 18 and 14 years, or she would be 22 and 18 years, then you can sort of play with the human life value number and bring it down by saying, all right, we might not be able to guarantee income all the way out to retirement, but let's at least try and guarantee income until emancipation of the youngest child, something like that. On the other hand, if the retirement plans are a bit questionable, or for some other reason the family just values trying to protect the income stream for potentially even longer, then it could be the case that you might even use a multiplier that would be higher than the multiplier between today's date and the projected retirement age. So again, some of this is going to be having to do with your own personal perspective and having to do with the perspective of the advisor that you trust. And I'm just sort of trying to give you the lay of the land without necessarily favoring one particular approach over another. Now, so the first one that we surveyed was debt replacement. The second was multiples of income. The third was human life value, which kind of further adds a little bit of a couple of other layers of subtlety onto the income calculation. The fourth method that I'll survey here is going to be what's called the DIME method, or the DIME approach, D-I-M-E, just like the little coin. So the DIME method is going to be the first one that's going to try to bring together these separate strands of debt and income replacement. And the way that the DIME method basically works is each letter, D-I-M-E, is going to stand for something that's going to be replaced, or something that the insurance is going to provide service for. So the D stands for debt, and just like in the debt coverage conversation that we had earlier, we're going to calculate our total debt. Let's just say that the debt is the same as it was previously. So we had $25,000 worth of car loans, we had $25,000 in student loans, we had $10,000 in credit card debt, so it's about $60,000. Now the I stands for income replacement, and let's say that we're going to import our value from the human life value judgment earlier and just stick with the 30-year figure, offset $2.1 million. The M stands for mortgage, and earlier with our debt calculation we used $200,000, so we can do about the same here. And the E stands for education allotment. So education allotment really could stand in for a lot of things. I mean, you could potentially build something in for an emergency fund, you could potentially build something in for legacy planning, but just on the DIME method, the question would be, do you want to have money left over to pay for the education of kids, grandkids, whatever, at whatever level, whether it's going to be private or parochial school in elementary, middle, or high school, whether it's going to be college at a state school, college at an Ivy League school. Obviously, it's going to change the calculation depending on how many years of school, what level of school, what type of school. All of these are going to factor into the cost. But let's just use a figure of $100,000 per kid, and we'll assume that there are 2 kids. So now if we round our debt up, just to make the math a little bit easier, round the debt up from $60,000 to $100,000, we would start with our $2.1 million figure for the income replacement, and we would add $100,000 for the debt. That would get us to $2.2 million. Then we would add $200,000 for the mortgage, which would get us to $2.4 million. And then let's say we wanted an education fund for 2 kids, and that would get us to $2.6 million. So in the DIME method, we might then say, putting both of those pieces together, we would want an insurance benefit level of about $2.6 million for this particular couple or this particular family. Now the last method is going to be the needs analysis method, and this method is going to sort of fine-tune everything that we've kind of discussed and go a little bit. I mean, needs analysis can kind of be a shorthand phrase for just kind of a grab bag approach, but the way that it is often applied is going to be to say, okay, we are going to have an insurance need that's going to be calculated something like a combination of considering the debt, considering the income replacement. There can also be considerations given for funeral expenses, so how much do you want to build aside for funeral costs. And in addition to that, there may even be allowances, let's say, for do you have retirement savings that could help to offset some of these coverages. Now, this is going to open up a lot of questions because, number one, you have to ask yourself, do you want your retirement savings to be reallocated to pay for funeral expenses or to pay for educational expenses in the event of the untimely death of a breadwinner? If you don't want your retirement savings to be touched, then your insurance amount is going to have to be larger than it would be without that. The other question, and I kind of touched on it earlier, is do you want to spend the death proceed or do you want to live off of the interest that the death proceed can provide? And here another closely related question is going to be how much faith do you want to have in the market or in the interest rate environment that will obtain when you need this payout? So for example, a person might say, well look, if you could get 10% interest, you could generate $100,000 a year with $1 million benefit. So you don't need $2 million, you don't need $4 million, you can do it with $1 million. And of course that's the case mathematically. You can do it with $1 million if you get the return. So again, the personal question is going to be how much faith, how much reliance do you want to have on the interest rate environment? If you've got a lot of faith in the market, then you might say, right, I can replace $100,000 a year of income with $1 million life insurance policy that once it pays out, I put it into a vehicle that's able to generate 10% interest a year. Let's say on the other hand, let's say you have absolutely no faith in the market whatsoever, and you say, I want this policy to pay out for 40 years. Well, you then say, okay, 40 years times $100,000 is $4 million, and you might then just say, I don't want to have any faith in the market whatsoever, and you try and get the largest policy you possibly can on the idea that what you're literally going to do is take that $3 million or $4 million payout and peel $100,000 off of it every year. And for all you care, that amount could be in a very low interest bearing account that has absolutely no potential really for any tremendous gains in it. And it doesn't matter because the amount of death benefit you have is sufficient to be divisible over the period of time that we're talking about. And then of course there'd be an intermediate approach where you might say, well, let's say we're not going to get 10%, but we're not going to count on next to nothing. Let's say we could get a moderate, let's say 5% interest rate. Well, in that case, we could generate $100,000 a year in interest with a $2 million life insurance payout. So what perspective you take, the faith you have in the market, the faith you have in the interest rate environment, the type of calculation that you're going to perform to actually calculate the need, all of these things are going to play a role when you're trying to determine how much of an insurance need you actually have. Just to rehearse the 5 calculation methods that I went through in this video. Number 1 was debt reduction. Just add up the debts. Number 2 was a multiple of your income. Just a straight multiple. Whatever you make, it's 10 times, it's 12 times. Different pundits recommend different levels. The third method for calculating insurance need is what's called human life value. It's just your salary times either the number of years you have to work or the number of years you have until your youngest child is emancipated or out of college, or you could even multiply it further out and extend it well into retirement. It just depends on the circumstance. The fourth calculation is the DIME method, D-I-M-E, debt, income, mortgage, and education fund. And the fifth and final method for calculating insurance need is what's called the needs analysis. I kind of described it as a grab bag approach that incorporates some of the elements of the other approaches. So once again, the actual method that's selected in your case would be a discussion that you have with you, your insurance agent, or some other trusted advisor. In other videos, I get into some of the things with respect to selection of policy. So for example, for a high level of death benefit, term insurance is often made to order for something like that. There are other occasions when something that has some kind of a savings or a cash value component may be more appropriate. But for all of these questions, for questions about calculating insurance need, for questions about what kind of policy you should get once you have determined the level of need that you have, all of those things should be done in conjunction with some advisor that you trust. It could be a financial advisor, an insurance agent, could be some other kind of trusted advisor, but you should have a conversation, and I would encourage you to not set it and forget it. I've done a number of videos on some of these topics. I have just posted a video talking about how in some cases an insurance need may exist even when you don't recognize it yourself. So hopefully you found something of interest in this video. If you did, I would ask that you just please like the video, subscribe to the channel. If you click the notification bell, you will be alerted to new content as it becomes available. And I thank you so much for joining me today. I look forward to seeing you again in another video.